Gold futures rose to a record today as the slumping dollar boosted demand for the precious metal. Gold has already gained 20% so far this year, reaching a new record high. And that's providing a lift to Agnico-Eagle Mines, a Canadian gold producer. Shares also up 20% so far this year. David Garofalo is this company's Senior Vice President and Chief Financial Officer. He's joining me now from our Toronto newsroom. David, welcome. Thanks for joining us.
Good afternoon.
So let's talk about what's going on with these gold prices today and really recently. Now, these are two sides of the same coin, but do you think it's more a question of the weaker dollar or the outlook for inflation? What's the bigger driving factor here?
Well, I think they are inextricably linked. I think the weaker dollar is really being driven by increase in monetary supply, the massive amount of government stimulus that's being introduced in the system, and really how the U.S. dollar does relative to other currencies. I think in the long run really doesn't matter, because I think you're going to see a competitive debasement among industrialized nations in their various currencies, because they're going to compete to have the weakest currency in order to preserve their export markets. So I think the gold price is going to do well relative to all currencies, not just the U.S. dollar.
And David, we talk to a lot of traders and people who are investing in gold about where the price is going. Obviously, you have a different perspective. What would be your prediction for where you see gold? How high can it go?
Well, the actual all-time high wasn't achieved recently. It was achieved in May of 1980 at $850 an ounce. And when you translate that into 2009 dollars, that's actually $2,300 an ounce. So we're well away from the all-time high we saw in gold back in May 1980 in real terms. We're less than halfway there. So I'm a believer in cycles. I think that gold is a currency like others. And in this cycle, it should achieve its all-time highs, which is north of $2,300 an ounce.
How long is it going to take?
Really, it just depends how long it takes for the central banks to find religion on inflation again. And I think they've thrown that out the window. It's really about stimulating the economy now at really any cost. They'll print money until the economy is reinflated. Unfortunately, when that happens, the horse will have left the barn at that point, and inflation will have galloped. It's quite possible we may see the same sort of stagflationary cycle we saw back in the 1970s, where you had high inflation, very low growth. Central banks struggled to keep the short end of the yield curve down, but the long end of the yield curve moved up violently, and that choked off growth. I think that type of cycle is definitely in the cards sometime in the next few years.
Now, David, when we talk to oil CEOs, for example, they talk about that they want to see oil prices not too high, not too low. They sort of like it in the middle there. From your perspective, do you want to see, is it just better to have gold go up and up and up, or are there any downsides to that?
Well, it's interesting because in spite of the fact that the gold price has been going up quite steadily since 2001, there's been a remarkable inelasticity of mine supply to that price. The supply, in fact, hasn't reacted. It's gone the other way. You would think intuitively that gold supply would go up in reaction to the price, but in fact, since 2001, we're close to 30% off our peaks in terms of mine supply. It's a very capital-intensive business. It's long lead time to production to cash flow. So we do need higher gold prices, I think, in order to see a supply-side response. So we haven't reached that sort of tipping point, if you will, for gold prices where, we're happy that they're at that steady level. We're still a long way away from where they need to be in order to ensure an adequate return on capital and to stimulate new supply.
David, let's talk about Agnico. This rising price, what's it going to mean for your company's bottom line?
Well, it'll all flow to the bottom line. We've never had a hedge book. We've never sold gold forward in our 52-year history. We've always maintained full exposure to the gold price. We think that's what precious metal investors demand. And so it means that we're going to have wider margins. We've never had wider margins than we've had now. We're seeing our production quadruple, as you pointed out, from our 2008 levels by 2010.
Right.
So we're hitting stride at just the right time. So our profitability will go up not only on an absolute basis, but on a per share basis as well.
And David,
because we've been very frugal with our shares.
David, we have about 30 seconds left. What's this going to mean for expansion for you?
Well, we're still looking for those greenfield opportunities. We're looking at in those development stage assets. We have a number of brownfield opportunities, existing projects that are already in production that have expanded geologically, and we think we can expand the infrastructure upon those deposits and ramp up production further.
David, thanks a lot for joining us. Obviously very timely with these gold prices rising. David Garofalo is CFO of Agnico-Eagle Mines.
And